Welcome all to Inspired Perspectives, Residential Credits and Incentives. Today, I'll kick us off. Then you'll hear from Joe Sawatsky, HERS Certified Rater, and Kristen Gustafson, Professional Engineer. They'll talk energy efficiency incentives. And then Shannon Brewer, Partner in charge of affordable housing, will wrap up for us. And here are the topics we will touch on today. Cost segregation, partial dispositions, a lot of energy stuff. 45L, MIP, R-PACE, 179D, and Energy Star, and we'll clean up with the low income housing tax credit. While many of these incentives cross over to public, commercial, and industrial industries, this webcast will lean heavily on residential, apartments, senior living, production home developments, townhomes, student housing, residential condos, and affordable housing. We won't be touching so much on short-term living like hotels. So let's get into it. Cost segregation and the often forgotten partial disposition deduction. Okay, so here is a definition from the Cost Segregation Mickey Mouse Club. Cost segregation is the process of identifying property components that are considered personal property or land improvements under the federal tax code. And they go on to say, the goal of a cost seg is to look at construction-related costs and see which ones can be depreciated over a shorter life, shorter than, in residential's case, 27.5 years. And while there is no regulation on cost segregation per se, the IRS has issued an audit technique guide to help their field agents perform audits. Part of the guide discusses these 13 principal elements. So looking at those, we won't go through all 13, but starting with the number 1, preparation by an individual with expertise and experience, all the way down to 13, looking at related aspects like 263 Cap A. The ATG essentially gives us the answers and the taxpayers the answers to the test so that we can perform a cost segregation study properly. And cost segregation in its modern form has been around since 1995. And started becoming very popular in the early 2000s. And here's a list of its benefits. Number 1, saves money by reducing taxable income. So you have to have taxable income. And if you do, cost segregation is a good tool. It accelerates depreciation deductions. So without a cost seg, you'll be depreciating something over 27.5 years. So you get 127. Cost seg will accelerate those into year 1. In some cases, years 1 through 5. It results in a positive net present value timing difference. So again, you're going to get the whole deduction over 27.5 years. With a cost seg, you get your money sooner. And so you can reinvest that money and get a positive NPV. It increases cash flow. Cost segregation is also very flexible. If you forget to do it in a given tax year, or maybe you don't have taxable income in a given tax year, you can go back with a Form 3115, change an accounting method, and grab that deduction. Cost segregation, it's a tried and true tax savings method that should be included in your tax strategy year in and year out. All right, here is the refrigerator example. A residential owner spends $50K on electrical work and $800 on a fridge. Through cost segregation, is estimated $300 of the electrical serving that fridge is spent. And so what that will look like on your fixed asset ledger, you'll have building electrical, $49,700 with a 27.5 year life. But then the building component that's being segregated, the electrical serving the refrigerator, gets a 5-year life, which is very similar to the refrigerator itself. It's also getting a 5-year life. So look at the bulls, building, 5-year, 5-year. And cost segregation is where those two meet. So it's that refrigerator example plus 100 other tricks of cost segregation that essentially result in about 15 to 30% of residential property construction getting an accelerated deduction. That's cost segregation in a nutshell. Let's move on to the partial disposition deduction. Here's a definition from our friends at the IRS. The PDD allows taxpayers to claim a loss upon the disposition of a structural component of a building or upon the disposition of a component of any asset without identifying the component as an asset before the disposition event. So the partial disposition, what they're saying here is an outlet to dispose of a portion, a component like a roof, of a bigger asset, a building, when your building is renovated. There was no outlet before this regulation. It came finalized in 2014. So there was no outlet to receive this deduction. So this is a net positive for taxpayers. And here are some notes to consider about the partial disposition deduction. One, it avoids double depreciating over a 27.5-year period. So if you renovate a roof and you start depreciating the renovation of that roof, but then there's the old roof still sitting in the building, you're double depreciating that roof. So the partial disposition allows you to take out the old roof, so you're only depreciating one item that's there. It's an election made by doing it. So by doing it, you've elected into it. And it's reflected on Form 4797, which essentially is where you put all your dispositions, your full dispositions. If elected, and this is a big deal, then the associated removal costs can be expensed in the current tax year. So any demolition costs that you have during your renovation can get expensed in year one, if and only if you elect the partial disposition. And the last bullet, this is why it's called the forgotten deduction, because it must be recognized in the year of disposition. So a taxpayer cannot retroactively claim a partial disposition deduction. That's very much unlike a cost segregation, where I just told you with the Form 3115, you can go back and catch up. You can't do that with the partial disposition deduction. That's why it gets missed quite a bit. All right, here's a renovation example. Taxpayer purchases an apartment for $5 million in 2019. 3 years later, they replace the roof, some AC units. They renovate 10 of the units at a cost of $550,000, with $50K of that for demolition. So that happens. You do a cost seg on it. You further should do a PDD analysis. Determines that the renovation partially disposed $300,000 of that original 2019 $5 million. So componentizing from a bigger whole. And when it comes to a PDD analysis, the IRS, and look in the sidebar there, they just require the taxpayer using a reasonable approach to engineer the cost of components being disposed. And so second bullet, taxpayer continues to depreciate the remaining 4.7 million. So that's that 5 million minus 300,000. So you're not double depreciating. And the taxpayer takes a net $260,000 partial disposition deduction, which is nice. And the reason it's net at 260, not the full 300, because over the course of those 3 years, that $300,000 has been depreciating already. Again, a timing difference, but still that $260,000, you got to grab in the year of disposition. And because this taxpayer elected the PDD, the taxpayer gets to expense $50K in the current year from that renovation cost as removal. All right, last slide before we go to energy. So during the webcast, you're going to hear about residential credits and incentives in a silo. We're going to talk about all these separate services, but keep in mind, these provisions can pair well together. And this is a good case study for that. So this is an apartment renovation in OKC, $50 million spent on a renovation for a 2- and 7-story building. It was historic on the National Historic Register, 400,000 square feet. And what they did was The 7-story hotel and the 2-story office were all converted to apartments. So this is kind of a unicorn where everything kind of comes together, but it's a good case study nonetheless. Cost segregation, a $5 million deduction, 45L energy, got a credit there of $400K, 179D on the hotel portion, $180,000 deduction. We're not going to be talking about historical tax credits, but if you have really old buildings, it's something to look into at the same time. And then the partial disposition deduction of $1 million. So it's important to look at credits and incentives holistically as it applies to your portfolio. And we see movements, this is a $50 million project, but we see movement on projects from $1 million plus typically. And with that, we're going to hand it off to Joe, energy efficiency incentives.
Yeah, no, thanks, Mark. I'm having some connectivity issues here. I was hoping to talk 45L and the rest, but last minute, Kristen's going to take over, and I'm sure she's going to do a great job with 15 seconds of preparation time. Thanks for that, Kristen.
Yep, no problem. So we're going to talk a little bit about energy efficiency incentives with Joe, hopefully providing some color commentary as needed, walk through the 45L, the 179D, as well as some financing opportunities, and then finish up with Energy Star. So what is 45L? This is a tax credit of $2,000 per qualifying unit for apartment buildings and townhomes, 3 stories and less, and as well as single family homes. So this credit is based on the date of lease up or the date of sale. So sometimes for these developments, that will span more than one tax year, and that is important to keep in mind. We'll look at a quick case study here. This was a single family 135 home development. Some of the features of this development included highly insulated ceilings and walls, windows of U value 0.5 with sensible heat gain of 0.27, and then heat pump heating of 8.2 HSPF. So as a result of this study, 100% of the homes were passed and sold, resulting in $170,000 in tax credits to the designer, to the building owner. And then another case study, this time for multifamily. This was a 56-unit townhome complex. Again, similar sort of complex features, highly insulated walls and roof, well-performing windows, and then a good performing heating system. As a result, 100% of the units passed and were leased, resulting in $112,000 of credits to the building owner. So what are the qualification requirements for 45L? The energy usage of the proposed developments must be 50% below a reference building built to the 2006 IECC standards. And the building envelope components must account for at least 1/5 of the reduction of that energy consumption. So the performance and the design of the building components really is important, as well as the climate and location. The certification process includes analysis of the drawings and specifications for each unit and unit type, as well as home type. The energy is simulated using IRS-approved software. Here at Eide Bailly, we use REMRate or Ecotrope. And then certification must be done by a person accredited by ResNet or an equivalent. How is this credit claimed? So we use Form 8908, the Energy Efficient Home Credit. This is used against regular tax liability, and it's done with a current year or with amended returns. So energy efficiency 45L, it pairs nicely with cost segregation when it's a new construction or a major renovation. The projects are leased or sold in an open tax year, and the building owner plans to hold on to the property for at least 3 years. We've put together this qualification overview. This is a list of the targeted efficiencies we're looking for 45L projects based on the location. So we put together these provisional assessments, and we'll do these for our customers free of charge for any potential projects. If it looks like projects are going to qualify, then we'll begin the engagement process via Salesforce. If it looks like projects won't qualify, we'll put together a non-qualification memo and include this minimum efficiency standard sheet for reference on future projects. So these are very quick and easy to put together. We're happy to do those for you. So some key takeaways on 45L. It's $2,000 tax credit per qualifying unit. It applies to privately owned residential or 3 stories and less apartment buildings. For properties sold or leased in an open tax year and prior to January 1st, 2022. We're looking at buildings with more than 10 units. This is not a requirement, but it tends to yield a better benefit to fee ratio. And the first step is typically a discovery call. We're happy to have a quick call with you and your team to go over the potential projects and talk about whether or not we think that they have a path to qualification. All right, next we're going to talk about mortgage insurance premium reductions for multifamily. This is a program run by HUD and the FHA insuring multifamily loans. And this can generate an up to 35-point reduction in your mortgage. So again, something to definitely look into. The path for this program requires adherence to certain green building certifications, including Energy Star for multifamily new construction. This is run by the EPA, and this is a program I'm going to be talking about a little bit in future slides. The National Green Building Standard, LEED, or Passive House, and these are available to both new and existing buildings. And then the last thing I'll talk about is Residential Property Assessed Clean Energy, or RPACE. This program was designed to encourage energy efficiency improvements. There are no upfront costs to the property owner, and it's typically repaid through property tax assessments, again, typically over 10 to 20 years. So if the property is sold, the repayment obligation needs to be transferred to the new owner as well. It's something to keep in mind. And the program requirements vary by location. Mark or Joe, anything to add to those slides?
Yeah, you're doing a great job, Kristen. Thanks so much for doing this. On this RPACE, it's a highly fragmented program. In some cases, it's based on an ASHRAE standard. In other areas, it's a, even based on local building codes. So obviously it'd be on the scope of this call to go through all of the program requirements. But if you're looking to do energy improvement upgrades on your facilities, it certainly it'd be worth a Google search, reach out to your provider or Kristen or myself to go through the program requirements. Typically requires some energy modeling and certification. And the good news, we have all that information, or all that capability in-house here with Kristen's team.
Perfect, thanks, Joe. All right, so next we're going to talk about 179D. This is the energy efficient commercial building property tax deduction, again, as it relates to residential building. So if your residential development is over 3 stories, 179D is another tax benefit to consider. As it currently stands, this is a tax deduction of up to $1.80 per square foot for qualifying properties. And for the purposes of this webinar, we mean apartment buildings or townhomes 4 stories and greater. A quick case study here. This is a 5-story multifamily building renovation in Portland, Oregon. Some of the building highlights included a highly efficient gas heating system with an AFU of 95.5, a 13-SEER cooling system, and LED lighting fixtures with occupancy sensors in the common areas. The end result of this study, the entire building qualified for the full deduction, resulting in an over $646,000 deduction to the owner. To obtain the full deduction using the whole building method, The energy usage of the designed building must be 50% below a reference building based on ASHRAE 90.1 standards. So ASHRAE is the American Society of Heating, Refrigeration, and Air Conditioning Engineers. And the standard 90.1, this is a benchmark for building energy codes throughout the United States, and it sets the minimum standards for energy efficient building construction. So we're looking to exceed that minimum standard. Those energy savings come from three categories of envelope systems, which means walls, roofs, and windows, HVAC and hot water systems, and lighting. We build an energy model using software approved by the IRS and the Department of Energy to compare the energy use of that design building to a similar building built to that ASHRAE standard or baseline. For buildings that aren't able to clear that 50% savings threshold as a whole building, we can look at each of the systems individually to see if partial qualification is possible. So each of those systems, envelope, HVAC, and lighting, they have different qualifying thresholds, which are shown here in pretty tiny font. But for envelope, that threshold is 10%. For HVAC, it's 15%. And for lighting, the threshold is 25%. And again, we use energy modeling to calculate the savings for each systems. Qualifications for any of these systems individually is 60 cents per square foot. So some key takeaways or beacons for residential buildings considering pursuing the 179D deduction. This applies to buildings 4 stories and above for a tax deduction of up to $1.80 per square foot, placed in service after December 31st, 2005, and we found a better return on buildings or developments larger in size than 25,000 square feet. Again, not a requirement, but the return on investment tends to work out better for all parties. Similar to 45L, 179D pairs nicely with cost segregation studies when the building's newly constructed or a major renovation was completed as of January 1st, 2006, and the owner plans to hold on to the property for at least 3 years. The last topic I'll cover is Energy Star certification for buildings. We've seen an increasing interest from our clients in certifying their buildings as energy efficient. And Energy Star, which is run jointly by the EPA and the Department of Energy, this is one of the most widely recognized symbols of energy efficiency by consumers. You're probably familiar with seeing this label on televisions, washing machines, things of that nature, but it also applies to buildings based on how much energy they consume compared to their peers. So the Department of Energy has collected some data around Energy Star certified buildings, including 7 to 8% higher rental rates, 10 to 11% higher occupancy rates for rented or leased properties, and 6 to 10% premium on sales prices when the property goes to market. Commercial building landlords intending to lease to federal tenants are required by the GSA to be energy certified. And as Joe mentioned, preferred financing is available to these Energy Star certified properties, particularly homes, including that MIP reduction. Some other reasons why building owners choose to pursue this certification include improved employee recruitment and retention rates, or simply because being green is an asset to your corporate image and useful for any ESG reporting that you might be subject to. So I'm going to do a quick case study. This is a multifamily development of 3 4-story apartment buildings and a clubhouse facility in South Dakota. We conducted a combination cost segregation and 179D study along with Energy Star certification in order to help the owner obtain that MIP reduction. So some of the building highlights here included a highly efficient gas-fired heating, 15C cooling, and LED lighting throughout. So these buildings were also designed to earn Energy Star. This means that the design met certain criteria set forth by Energy Star, which were intended to reduce energy consumption. The end result of this combination study, a deduction of $500,000 from the 179D study, a $2.7 million net depreciation from the cost segregation study, in addition to the Energy Star certification, which enabled the building owner to obtain that MIP reduction, which will save hundreds of thousands of dollars over the life of the loan. To complete the application process for Energy Star, building owners need to collect some data about the properties, including the use details, the operating hours, number of staff, things of that nature. You'll also need to collect the utility bills for all energy sources, including electricity, gas, etc. So for apartment owners with individually metered tenants, you need to get a plan in place to obtain the utility data. And the ease of this process, unfortunately, is highly dependent on your utility provider. So if you intend to pursue this path, it's important to have that discussion with your utility earlier rather than later. Some of our clients will even put these utility agreement notices in their leases. So it's important to keep that in mind. Also important to note, 12 months of continuous utility data is needed for the certification. So that means the building needs to be operating for a full year before a certification can be obtained. The benefits of doing an Energy Star certification in conjunction with a cost segregation or 179D study is that site visits are required for both of those programs, so the needed data can all be collected at the same time. The purpose of the Energy Star site visit is just to confirm that the building is operating in a way that's energy efficient, but also beneficial to the occupants. So it's a nice space to be in. CO2 meter readings, those are taken to ensure that there's sufficient outdoor air in the space. Temperature and humidity readings are taken to ensure that the environment is comfortable, and light measurements are taken to ensure that the light levels in the building are adequate for the tasks that are taking place. So after all this utility data and the site visit data has been provided, the information is entered into Energy Star Portfolio Manager, and then the report reviewed and certified by a licensed professional and submitted for review to the EPA. A score of 75 is required for certification, which means that the building uses less energy than 75% of its peer buildings, which is adjusted for climate, usage, and square footage. So this may sound like quite a high hurdle, but bear in mind that for newly constructed or renovated buildings, they're being compared with existing building stock, some of which may be several decades old with correspondingly aged mechanical and electrical equipment. So it may not be as big of a lift as you might think. And so I'm happy to answer any questions you have on Energy Star, 179D, or 45L. And please post your questions in the chat or feel free to reach out offline. And with that, I will be turning over to Shannon to go over the low-income housing tax credit.
Not so fast, Kristen. Shannon's going to have to hold on. A lot of good questions, a lot of silly questions. I picked out 3 of the better ones and maybe keep you on the hot seat, and if Joe's around, him on the hot seat. The first one has to do with success rate of 45L. What are we finding as a success rate with that program, maybe compared to some of the 179D and the cost seg?
Sure. Well, the hurdle to achieve 45L qualification is definitely higher than that of 179D. So I don't have any data around our success rate. I will say that qualifications checklist that we showed a couple of slides earlier kind of gives some of the boundaries for projects that have a better chance of succeeding in that credit. Some things that we've seen that do indicate a good chance of passing are using heat pumps systems, having the framing system, a 2x6 framing system. Maybe Joe can give a little bit more detail about that, as well as mechanical ventilation. So those 3 things indicate a higher chance of passing.
Yeah, for sure. Just to piggyback on that, and hopefully I don't freeze up here, but yeah, it's highly dependent on climate zone and local building code. So it's a challenge to say, if you put in this level of insulation or this level of cooling or heating, you will or will not qualify. The requirements up here in Minneapolis are quite a bit different than that out in Phoenix, Arizona, for instance. And so it's very much on a case-by-case basis. And so kind of part of our process, not to throw a sales pitch out there, but part of the discovery call process is to kind of talk through, you know, the building systems as they're designed or already in place. And then we can come back and one of two things will happen. We can either say, yeah, this looks like it'll be a good candidate for qualification, or if it's not, if there's some areas of deficiency, what we do is we can put together a non-qualification memorandum and say, gosh, you know, you're deficient in these areas as it pertains to the tax credit, and then provide hopefully some cost-effective remedies, either, you know, during the design process or even after the fact. Chris mentioned mechanical ventilation. That's a relatively small lift, even after the project is placed in service. You know, that might get you over the hump, and we see that all the time.
Thank you, Joe. Thank you, Kristen. Question number 2. A couple people are asking about this. Congress, in their infinite wisdom, what's the latest on legislative affairs, and where do we think this might get extended, and what vehicle might it be attached to? What are our thoughts there with 45L?
Sure. Yeah. So it's just alluded to this 45L is one of these extended deals. So it's starting the Energy Policy Act 2006 and has undergone a half a dozen 7 expirations and renewals in that time. So as it stands now, as you saw, it only applies to projects first occupied as of 12/31/2021. I just talked to a couple of guys out in Washington, a couple of our guys out in Washington this morning. We think / hope that we'll have resolution on what the next renewal looks like, hopefully before the August recess. That's the hope, and we'll see what happens in Congress per the usual. At the end of the day, we fully expect it to come back in some way, shape, or form. It's one of these credits that both sides of Congress can get behind, right? On one side, we're going green and saving the planet, and on the other side, we're, you know, spurring innovation and spurring building construction and bringing down home prices. So it'll come back for sure. What it looks like, we don't know. Maybe it'll just be an extension in the current form based on ICC 2006. There's some talk of changing it, or at least in the Build Back Better, which they might incorporate into some new legislation whereby it'll be more off the Energy Star standard. And in that case, depending on the level of qualification, it could go up to as high as 5,000. Have to wait and see. We're just not sure yet. Hopefully we'll have resolution by August, but at the end.
And I'll close up for Joe. In short, you never know what Capitol Hill is going to do. But with that said, we do have precedent. The 45L has been extended every year since its inception in 2006. So it's just a matter of what vehicle are they going to attach it onto. I think it's incumbent on this group to prepare for it and be proactive about it. It's not a slam dunk like a cost segregation. It takes a little work. So have the professional assessments sooner than later. So when it does come back online, we are on the ready. And furthermore, for projects that are from 21 and before, we can grab those. All right, last question for the hot seat for Kristen. And I think it'll just be Kristen here is there a difference between single family homes versus apartments with 45L, or is it kind of treated the same way?
They're treated the same way. In the current legislation, it's $2,000 per unit. So for these larger apartment complexes, $2,000 per unit can add up pretty quickly. Similar with single family home developments, the larger developments, those can add up very quickly.
Okay. All right, Kristen, I think you're off the hot seat. And with that said, we'll have Shannon Brewer, leader of our affordable housing practice here at Eide-Bailly, talk about LIHTC. Shannon?
Thanks, Mark. And first, thank you to everybody today for attending the session before this long weekend. As mentioned in the beginning, my name is Shannon Brewer, and I'm a tax partner with Eide-Bailly in our Fargo office. And I specialize in the affordable housing industry. And we are going to cover a lot of information on the low-income housing tax credit in a short amount of time. So let's get started. So first, let's just start with the basics of what is the low-income housing tax credit. People hear a lot about cost seg, they hear a lot about 45L, you know, just generally, but not often do they hear about the low-income housing tax credit. The low-income housing tax credit was enacted in 1986 to encourage the development of low-income rental housing. The credit is allowed over a 10-year period, beginning with the year the property is placed in service, or if the taxpayer so elects the following year. This is what we call the credit period. The credit rate is calculated so that the 10 equal annual installments have a present value equal to 70% of the cost of the units or 30% of the cost of the units, depending on how the deal is structured or financed. And this 70-30, this is what we call the 9% or the 4% credit, which is the term that most people are familiar with. The 9% credit is available for projects without any federal subsidies and can include new construction projects or rehabilitation costs of an existing building if certain thresholds are satisfied. The 4% credit is available for new construction with federal subsidies or for the acquisition cost of an existing building. So can anybody claim this credit? Well, the answer is no. The credits are awarded from the IRS to each of the state housing agencies, who then award those credits to projects within the respective states. The developer who is desiring to rehabilitate a project or construct a new project utilizing low-income housing tax credits must submit an application to the state housing agency. The state looks at the applications and then determines which projects will be awarded credits. It's based off of a point system. The owners or the developers must maintain the rental property and only rent to tenants who meet, strict income and asset requirements. And the rents are required to be set low enough to meet specific guidelines. Various agencies can monitor these projects, HUD, RD, housing agencies themselves. But if there is non-compliance, the state actually notifies the IRS of the non-compliance, and then recapture of these credits can occur. Deals are generally structured as partnerships, including triple LPs and limited partnerships and LLCs. Normally, you have the general partner who is the developer, and then the limited partner is the investor. The investor is someone who has an appetite for the credits and is willing to invest money in exchange for credit. So they'll put money into the deal as equity in exchange for their share of credits and losses. Once a project receives an award of credits from the state, various compliance items must be completed. So for 9% deals, a 10% carryover must be prepared by an independent public accounting firm, and then that has to be submitted to the state by the appropriate deadline. Upon completion of the project, like once the buildings are completely done, then an independent public accounting firm must prepare what's called a cost certification, which calculates the amount of the credit. This is then sent to the state, who then issues the form 8609. The 8609 is the form that is required in order to claim the tax credit. So going back to the original question, can anybody claim this credit? The answer is you have to have this form from the state. You can't just all of a sudden start claiming this credit. Once the form 8609 is received, it must be completed, signed, sent to the IRS, and then the project can begin claiming tax credits. While the credits are claimed over 10 years, which I had mentioned, the compliance period is 15 years, meaning that some of the credit can be subject to recapture during the entire time period. Items that could potentially cause recapture include, non-compliance with the programming, having a tenant in the unit that's not actually qualified, casualty loss impacting the building, various items. So this is an annual credit that is claimed for 10 years. The amount of the credit is determined in the cost certification previously mentioned, but specifically, this is equal to, it's the credit percentage multiplied by the project's qualified basis. So that's the math to come up with the credit. And the qualified basis is the fraction of the costs of the project that are rented to tenants meeting the income tests. So projects do not need to be 100% affordable, but if they're not going to be awarded credit for all of the costs of the project. The credit is reported on Form 8609A and 8586. It flows to the Schedule K1 of the partners in the partnership. This is a general business credit, which does have its own limitations. This credit does offset the alternative minimum tax, but that doesn't really impact corporations now anyway, but important to note. So let's spend a little bit of time looking at how the credit is determined. Once the project is complete, the credit is determined by computing the eligible basis. And this is really our starting point. Eligible basis takes all of the project costs and, in total, everything that was spent on the project, and then backs out all of the costs that are not eligible. So some examples of items that are not eligible for the credit include the cost of the land, loan fees, reserves, demolition, syndication, organizational costs, and then any costs for commercial property in a project are not eligible. The qualified basis is the portion of the eligible basis that is attributable to low-income housing tenants. And these are all terms within the industry, the eligible basis, the qualified basis. So the qualified basis is the portion of the eligible basis that's attributable to the low-income units. If a project is a 100% low income, then these amounts are going to be equal. Qualified basis is computed by taking eligible basis times what's called the applicable fraction. And the applicable fraction is the lesser of the percentage of low-income housing units or the floor space occupied by income qualified tenants. There is a special rule for the first year of the credit period, which basically says the first year calculation takes the lesser of the unit or the floor space fractions at the end of each month and then computes a weighted average for the year. So in your first year, you don't just get like a full year of credits, basically. You have to look at when the units were actually qualified. Note that the building must be placed into service for a full month in order for a month to be included in that first year calculation. So let's look at an example. It's always easier to see through an example. So in this example, we have a newly constructed building with eligible basis of $1 million. The building has 100 units, of which 60 are for low-income tenants and 40 are for market rate tenants. The floor space of the low-income units is 500 square feet, and for the market rate units, it's 600 square feet. The unit applicable fraction is 60 over 100, which is 60%. That's our 60 affordable units out of the total. And then the floor space applicable fraction is 30,000 over 54,000, or 56%. And that 30,000 is computed by taking the 500 per unit square foot of the low-income units times the number of low-income units. We have to take the smaller of these two fractions as our applicable fraction. So we have to use the 56%. And in taking the 56% times the eligible basis of $1 million, we have 560,000 as our qualified basis. So maybe that makes a little bit more sense seeing it in an example. So in order to be considered a qualified building, one of the minimum set-aside tests must be met. And this means that a minimum number of units must be for use by low-income tenants. And the owner actually elects which minimum set-aside test they intend to utilize. The 2050 test means that at least 20% of the units will be rent restricted and occupied by tenants whose gross income is 50% or less of the area median gross income. And the 40-60 test, similar, means that at least 40% of the residential units will be rent restricted and occupied by tenants whose gross income is 60% or less of the area median gross income. And then the average income test requires at least 40% of the units to be rent restricted and occupied by tenants whose gross income averages 60% or less of the area median gross income. So it's important to note that this test must be met by the close of the first year of the credit period for the building, meaning that these units must be occupied by qualifying tenants. And remember, and this is important to note, that the credit period ends in either the first year the building's placed in service or in the following year if the election's filed. So if you have a building that is struggling to rent up and it maybe isn't going to meet this minimum set aside, that's when you file the election and you push it to the next year if you need to. So as I mentioned, the first year of allowable credits is determined by taking the sum of the applicable fractions as of the close of each full month the building is placed in service, and then dividing that by 12. Any credit not allowed in year 1 based on the calculation is allowed in year 11. The taxpayer can elect to defer the credits, as we have mentioned, into the following year, but that's only for the first year. So let's look at another example. So in this example, we have a low-income housing eligible building that was constructed for $500,000, not including the cost of the land, which we know is an ineligible cost. The building has 50 units, of which 40 are designated as low income. Those 40 were rented by qualified tenants in time to meet their designated minimum set aside. The low income units were occupied in October, November, and December. So how much credit is available in year 1? Well, the allowable amount is $4,320 computed. So first we have to start with our eligible basis, which is the $500,000, but we must multiply that by 80% because 10 of the 50 units are not low income units. So our qualified basis is $400,000. Our credit rate is 9%. So the allowable annual credit is $36,000. The low income units were occupied and qualified from October through December, with 10 units in October, another 10 units in November, and then the final 20 units in December. So our applicable fractions are 0.2, 0.4, and 0.8. When you add those up, you get 1.4 divided by 12, you get a first year applicable fraction, which you then multiply that by the $36,000 annual credit amount, and we're allowed $4,320 of credit in year 1. The remaining $31,680 will be allowed in year 11, so it's not lost. Remember that the applicable fraction is the lower of the unit fraction or the floor space fraction, but for purposes of this example, we've only used the unit fraction, but you would need to look at both of those. And also, important to note, if you have excess basis in a deal, you can use that to allow some additional credits in year 1 versus year 11. But this particular example doesn't illustrate this option. So let's move on and talk about how you can pair a low-income housing project with cost segregation and 45L to kind of just bring this whole hour home. So we know an eligible project can claim low-income credits for 10 years. But adding a cost segregation study allows costs that would be taken over either 27.5 years or 30 years through depreciation of the building to be deducted in the year the property is placed into service through bonus depreciation. The reason that I say 27.5 years or 30 years is because if the partnership files a Section 163J real property trade or business election, the building must be depreciated using the ADS system over 30 years and not the traditional 27.5 years under makers. So that's important to note. Not a huge difference between the two, but something to consider. Bonus depreciation is 100% for 2022. So anything pulled from the building is available for an immediate deduction. Note that bonus depreciation is scheduled to decrease over time, but this could change at any moment without notice, I imagine. Utilizing a cost segregation study can substantially increase the tax savings for an investor. And in addition, 45L credits can be added to a project. A low-income housing project that already intends to be energy efficient, for example, in order to lower the costs of utilities for the residents, could be a really good candidate for 45L. A significant item to note is that the 45L credit does reduce eligible basis for low-income housing by 100% of the amount claimed. And that's something that we'll show through an example. So this means that if you're receiving a 45L credit, you don't also receive the low-income housing credit on that amount. So in other words, you can't double dip. 45L can work well with a 9% project that is going to have excess costs. With a significant increase in construction costs today, we're seeing a lot of 9% deals that have eligible basis in excess of the amount needed to claim their low-income housing credits. So in that case, reducing the amount of the 45L credit will not impact the amount claimed for the low-income housing credit. So let's walk through a case study here. This project is located in Colorado. It was a 50-unit new construction, 9% deal that was placed in service in March of 2020. The project was located in a qualified census tract, which means it is allowed a 30% boost in qualified costs. So a qualified census tract is an area designated as such by HUD and generally has 50% of its households with incomes below 60% of the area median gross income. So in other words, it's an area identified as one needing affordable housing. And as an incentive to get developers to develop in these areas, they're given a boost to their qualified basis. This project was awarded credits from Colorado equal to $1,185,541 per year for 10 years. We're assuming a corporate rate of 21% and a state tax rate of 4.63%. So here is the calculation of eligible basis, which, you know, a lot of stuff on there, but it's the same process, right? We start with the total costs of the project, and then we back out all of the costs that are not eligible for low-income housing tax credits. If we claim 45L credits, assuming each unit qualifies, the amount would be $100,000. Remember that this is as we mentioned, this is a reduction in eligible basis for low-income housing purposes. So we add that in as a reduction. That puts our eligible basis at $12,796,439. And when we receive the 130% boost on there and we have a 9% credit rate, it gives us a tax credit of $1,497,183 when you do the math on it. So the low-income housing credit schedule, which you can see, shows that in the first year, we were allowed through the computations to take 923,313 of credits. You'll notice that even though we computed in the previous slide credits of 1,497,183, we're limited to the reservation amount of the 1,185,541. So this means this project has excess basis. So in other words, even though we calculated a higher amount, we cannot claim more credits than what was awarded to us by the state. Again, this is why the reduction of the 45L does not impact our total credits because we already have excess costs. When the depreciation, so in this project, this deal had $1,296,439 in depreciable assets with first year depreciation of about $3.7 million. And then when you combine the depreciation with the low-income housing and the 45L credits, the potential tax savings was almost $2 million for the year. So had the project not had a cost segregation study or 45L credits, it would have looked a lot different. So let's just walk through a side-by-side comparison. First, you'll notice that with or without 45L, the total amount of low-income housing credits does not change. And that's because even though we had to reduce eligible basis by the 100,000 for the 45L credit, there was sufficient excess basis for the low-income housing credit to still be able to claim the total that it was awarded. The amount of the credits claimed in year one in 2020 is smaller with 45L than without. And that's just because of the 100,000 reduction and the computation of the first year credit. But the total credits overall were the same. Without the cost segregation study, depreciation expense in year one would have been over $2.5 million less. And without the cost segregation study in 45L, the tax savings would have been almost $750,000 less. So some items to consider when planning include whether or not the investor is interested in purchasing 45L credits. Do they have an appetite for 45L credits? Are you already going to have energy efficient units? If not, how much is it going to cost to get you there? Also, if you're going to accelerate depreciation through a cost segregation study, a Section 704B analysis must be done to make sure that the losses and credits can be allocated to the investor during the time that they're in the deal. So low-income housing, the low-income housing tax credit pairs really nicely with a cost segregation study where the investor is seeking accelerated deductions. And we've had an analysis that shows that the losses in the credits will still be able to be allocated to the investor during the 15-year compliance period. And the low-income housing tax credit pairs nicely with 45L when the units are already likely to qualify, where there are excess costs, so that total amount of low-income housing credits will not be impacted. Generally, you want to plan for these before the project is done so that the investor has them in their projections. And, the struggle there is with the ever-changing laws, will the 45L be extended? I mean, likely it will. What's going to be bonus depreciation? Is it going to be 100%? Is it going to be less than that? What's the corporate rate going to be? Is that 21%? Is it going to be 25%? So, planning is a challenge in our ever-changing environment. So we encourage you to reach out to your tax professional and get some help working through some of this.